Good evening. This is Ken Long from Tortoise Capital Management with the daily market health check and daily trading plan review for December 29th, 2010. We're still in bull quiet mode. We're at the high range of neutral on the annual. Slightly over, not slightly actually, well overbought on the 10-day. The percent stretch above the 200-day moving average and the slope of the 50-day moving average are both bullish, very strong. ADX is now above 27 at 27.3, and ATR percentage is still extraordinarily quiet at 0.63%. We're now up on the gap stat to having 56% of the time, almost 57%, we've had a reversal of the gap. So 17 times out of 30, it's either gapped down and reversed to close higher, or it's gapped up and then closed lower over the last 30 days. Standard deviation of the gap remains 0.75%. The average largest intraday move remains 2.33%. You can see that we've been overbought for a considerable period of time. No signals in overreaction and channeling. Pivot points now above 126. So 3% away from the first significant support level at 123. 10-day maximum pain. Some old reliables: American Express, Alcoa, Intel, Merck, and J.P. Morgan. So financials will still be on our short list to watch. Among the ETFs, it's India, China, biotechs, home builders, gold miners. Quite a few pattern trades to look at in the 5 days down: Amgen, Lowe's, and Comcast. That's kind of surprising given how much the market's been going up. So there's a real divergence now between those symbols and the broader market. So that's an interesting candidates for tomorrow to look at. I actually traded Lowe's some this morning and squeezed a fractional R win out of it. Under the 551W, we have Germany, and then a whole slew of large caps. I'd be focusing on the first four: Caterpillar, Disney, Coke, and Microsoft. Triple screen, we have Lowe's again. So Lowe's is not only a 5-day down, but it's also a triple screen, which is very favorable because you have a strong market, a strong prior trend, a measured 5-day pullback, which is now closed below the 20-day moving average, and is oversold on a Williams percent R basis. So Lowe's is a very strong candidate for tomorrow. In the daily tactical, the percent losers today: Home Depot, Procter & Gamble, Alcoa, Cisco, and J.P. Morgan. The winners were IBM, Disney, McDonald's, and Walmart. On the let's see, I guess we could look at American Express is still over a max pain on the 10-day basis, as is Alcoa. Alcoa is going to be interesting to me tomorrow. It's oversold, or I'm sorry, max pain on 10-day, 3-day, and was a percent loser today, so it's automatically on my short list. In the ETFs, you can see just how many of them are overbought on both an annual and a 10-day basis. The percent losers today: oil and agriculture. Percent winners: coal, silver, and then the internationals: EEM and ILF. Lots of dojis in the Dow, as you can see. If you look at the daily chart on the SPY, that shouldn't surprise you. It was extremely small range today. Channeling signal in Merck, and then four patterns on the 551W: Microsoft, Coke, Disney, and Caterpillar. Walmart is actually pretty interesting here, with being outperforming on 1, 3, and 5 days, and yet still is a max pain range compression. On the ETFs, not as many dojis. No other pattern trades other than the max pain range compression. Natural gas, Europe, healthcare, Dow, the Dow diamonds, and then consumer staples. In the elder safe zone, most everything got stronger today. There were no negative trend signals. And emerging markets, Asia less Japan, Japan, gold, Latin America, Taiwan, and silver. Silver had a nice pop up and was able to hold that and test the all-time high today. Never quite broke through, but it's so close that if it breaks through the all-time high, watch for an explosion on the upside. You can see how tight the slope of the 30-day regression line is, describing the last 30 days with the R-squared statistic at 0.89. It's still nudging above the 1 standard deviation above normal. Right now, it can still go another half a deviation, which would give it another 5%, and that would another 5% would take the stretch above the 200 up here near 2 standard deviations, which would be an extraordinary, quite an extraordinary move, and you can see that unfold on the price chart. Those are the things I want to look at for today. That's the daily trading plan. No change from the previous days. We're still watching financials and the Max Payne, and we're looking for continued momentum in silver, and that can be played both ways. If it's up and stronger than the market, we're looking at silver at AGQ, which is the 2 times silver leveraged ETF, and silver Wheaton, symbol SLW. It was a good trade today. And then a pullback, if it fails to test and break through, if it's a reversal in profit taking, then our target on the short side would be ZSL, which is 2 times inverse silver. I'm reluctant to go short the strongest sectors. I'd rather find something that's been weak and it is currently failing. Nevertheless, there's reason to believe that silver on the short side could be a good play, since its profit-taking tends to be massive on the first day and a little bit of follow-through on the second day. If you take a look at silver historically this last year, even in the middle of the strong up move, it's had 1 and 2 day sell-offs for profit-taking that have been lucrative on the short side. So ZSL remains on our short list. And thanks to our good friend Swen in Switzerland for keeping us alert to both sides of that trade and recognizing that it is a trade and not a belief. That's all for tonight. Good trading tomorrow, and looking forward to the new year.